Everyone says DeFi replaces banks, but this paper shows something kind of different. Okay, so we've talked about borrowing against your crypto recently, and it's not very often that Canada puts out interesting comments in crypto land, but our central bank, the Bank of Canada, just released the paper on DeFi lending, and it's probably not exactly what most people think. So the paper focused on DeFi lending on the Aave V3, which is the largest DeFi lending protocol by total value locked. And the read is a bit dense, so I'll try to break it down simply. So DeFi lending is basically borrowing and lending without a bank. So no credit checks, no identity or KYC. And instead it runs on collateral and code. Here's how the basic model works. You deposit your crypto and borrow against it. And each asset needs to be over collateralized, meaning that you have to deposit more than what you'll get back. And each asset has its own loan to value ratio depending on its risk. So more stable assets let you borrow more, and more volatile assets, it's less. So this isn't really a traditional loan. It's more like unlocking liquidity in your own asset. They also mentioned that many users aren't just borrowing, they're doing something called looping. So what that means is that they borrow and then they swap it into another asset and deposit it again, and then borrow again and over and over and over. And in this paper, they found that about 20% of borrowing activity comes from this. So this isn't just lending, it's now leveraged exposure, which obviously increases the risk. So if you ask, how does the system break? Well, in DeFi, everything comes down to something called your health score. And if it drops below a certain level, well, you get liquidated. And that happens automatically. So no margin call, no warning, no negotiation. So the liquidations don't happen slowly, they happen in waves. And this paper shows that on the Aave network, they cluster during market drops, and about 90% of them are tied to a small group of assets like Ethereum, which means one sharp move in price can trigger a cascade. And if you're wondering what causes this, well, it's not interest rates and it's not bad decisions, it's price. Then the data shows that 84 to 97% of liquidations are caused by collateral price drops. So if the market moves fast enough, you're out. And the real cost that I think most people will underestimate is that you don't just lose your position. You get hit with liquidation penalties and you miss the recovery if the price bounces back. And the total impact, well, they estimate it to be somewhere around 10 to 30% loss. So in the end, the takeaway from this paper is that banks will manage risk over time, and DeFi, while it enforces and incentivizes it instantly. Because there are no defaults in DeFi, the system forces liquidation before that can even happen. And the risk, it doesn't disappear. It just transfers directly onto you. So do you think that DeFi actually replaces banks? Or is that a level of risk that the general public just isn't ready for yet? Let me know your thoughts in the comments.